Hi, thank you for joining for our May Economic and Market Update video. My name is Dave Mantell. I'm a certified financial planner and managing partner with Stabler Wealth Management. For today's video, we'll cover year-to-date market updates and what we're seeing with the economy, as well as the outlook going forward. Before we dive in, it's always good to review that main concept that knowledge is power. Especially during uncertain times like these, being educated on the ins and outs of what's happening in the economy and how your portfolio and financial plan is constructed to weather these periods creates confidence in our view and results in better outcomes. And so our mission with doing these videos is to provide updates and insights to help our clients better understand what's happening and how they're positioned to maintain their wealth and their goals during these stretches. Looking back at the first quarter of 2023, overall it was a pretty solid quarter. Despite the massive volatility that we've seen with all the banking crisis concerns, as well as strains in other areas of the market such as commercial real estate, the stock market ended notching a pretty solid quarter, with the S&P 500 up over 7% and the Dow Jones up slightly about 0.5% for the first quarter of 2023. What's interesting is, as you can see, while the S&P 500 rose 7% during the quarter, it was very uneven gains where the majority of the returns came from a select number of stocks in the technology space specifically. 10 companies in the S&P 500 contributed 90% of a return for the quarter, and only 3 companies, Apple, Nvidia, and Microsoft, contributed nearly 50% of the market's return in that first quarter. This further explains why the Dow Jones was only up about 0.5%, despite the S&P being up 7%. And interestingly, a lot of these companies that performed really well to start the year were the ones that struggled more so in the prior year, and vice versa. Now, while it's been a very bumpy year and a half, as we're all keenly aware, when you take a look back at the last 6-7+ months, it actually tells a bit of a different story. While there's been no lack of volatility, if you see on this chart, since the lows of October start in 2022, the market, the S&P 500, is actually up approximately 15% since that period through the end of April. And so while it's been a very bumpy ride to get there, we have seen some good progress and strength in the last half year, coming off a really difficult first 9 months of 2022. While we are seeing some progress, as noted, there's been no shortage of volatility. So amazingly, as you look at the number of days where the stock market, the S&P 500, was up or down over 1%, last year notched about 150+ days where the market saw such a movement. Nearly half the days of the year, and essentially half of the trading days. This year, we have continued to see volatility, not quite at the level of last year, but as noted, for example, in February into March, with a lot of the banking issues of Silicon Valley Bank and other headlines, including the worries about the debt limit currently, there's been no shortage of volatility. And no matter what the market does this year, that's something that we do expect to continue, whether it's upward, sideways, downward volatility. While this movement can be a great distraction and an attraction for the different media outlets that love to really grab those eyeballs and create a lot of strain and stress, in the scheme of things, for long-term investors, this volatility is part of the deal and something that we know we're going to come across, occasionally year to year. When looking at the broad economy, really in our view, one of the main items to look at is inflation. Really what triggered the 2022 market turmoil was really rapidly high inflation increases and large headline numbers that really caused prices across the board to really increase and force the Fed's hand to react to that and try to batter down and maintain that inflation. And so as we look forward, inflation is going to continue to be a key driver in our view in terms of what the economy and short-term what the market does. Looking at the trends from the high in July of 2022, where inflation eclipsed 9% year over year, we've seen a really strong gradual reduction, where in January that number was down to 6.4%, and most recently in April, inflation was down under 5% to 4.9% year over year. So market progress. With that in mind, 5% is still more than double what the Fed's inflation target of just over 2% is. And so there's a long way to go going forward. And it's unclear, while we are pleased with how quickly we've gone from that 9 to 5% level, going from 5 to 2 can potentially be much more sticky and drawn out. So that's something to really keep our eyes on, as that will be a primary driver of where interest rates are and largely the economy performance in the years ahead. As anticipated, to combat inflation, the Fed has continued to raise interest rates. In the past year plus, we've seen the fastest interest rate increase in 40 years. And so it's been very dramatic, going to essentially 0 to 5%. Most recently in May, the Fed raised rates another 0.25%, taking that target to 5 to 5.25%. And we will see as the year continues where rates go from here. The early indication is that the Fed may be at a point where they're ready to pause or close to pausing. And the general market expects interest rates, we may see cuts as early as September. With that in mind, as noted on the previous slide, it's very unclear where inflation goes from here. And so we do need to be prepared to live with higher interest rates, potentially longer than is currently expected out there from many of these market indicators. And so as a financial professional, this is something that we're going to keep a vigilant eye on for our clients, and how to maneuver, given where interest rates are and many of these other factors. So Treasury yields have seen an interesting movement so far this year. Initially, with the shutdown in Silicon Valley Bank earlier this year, you saw a rush into safety, and Treasury yields came down, bonds were performed strongly in response to that. Therefore, after the Monday after the Silicon Valley Bank collapse specifically, the 2-year Treasury bond yield posted its biggest 3-day drop since the aftermath of the 1987 Black Monday stock market crash. Likewise, the 10-year benchmark Treasury also came down, retreating below 3.5% at one point. Since then, we've seen the 2-year Treasury climb back over 4%. And we do think short-term treasuries are still providing very favorable yields in this environment, and very solid returns at a safe level, which is a good reminder. While interest rates going up has provided a lot of pain for the general economy, for savers it's created much higher return on income investments, which we continue to see maintain. Looking at this chart, we can see how changes in interest rates affecting treasuries the most for over a decade. And as noted, investors are now able to generate a nice, reasonable return on their more conservative investments. And so you could see nearly going from 0% to 5%, we've seen a massive increase in interest rates, relatively speaking, here in the past year plus. Now, when you're thinking about safety, it generally comes with a cost, and not all cash equivalents and safe holds are created equal. For example, when you look at the major banks out there, they are still providing very low interest rates to savers, with the average bank money market, less than 1/3 of a percentage point per year that it's paying, and even the average 12-month CD only 1.6%. In contrast, the Fed funds rate, which really drives interest rates, is up over 5% now with a recent May hike. And therefore, there are a lot of instruments between treasury bills, money markets, where you're able to get a return on your cash equivalents more in line with this 5% number. And therefore, it's very important that for your safe investments and your more kind of war chest type funds and cash equivalents, you really need to be, in our view, earning that 4 or 5% a year figure. And again, not all banks are providing this. So for anyone with excess cash or savings on hand beyond kind of their operational comfort level, we do suggest talking to us, and we could look at earning some additional yield in a very conservative way on these funds. So we've all heard the adage that when interest rates go up, bonds go down, and vice versa. And this really rarely became more clear than in 2022, whereas interest rates went up, from essentially zero to a sizable portion, we saw bonds take a really tough drop. Incredibly long-term government bonds, 20 to 30-year term, were down over 30% in 2022. This is something that's typically considered a safe investment, right? Yet it well underperformed even the more growth-oriented stock market investment options out there. And so we thought this is a good time to kind of look at under the hood and explore what causes that dynamic and provide a bit of color how we think about client bond portfolios in relation to this. So simply put, if you're buying a government bond, you're making a loan to the government. And therefore, if you're providing a 2-year government bond, a 2-year loan to the government, what happens is each year you earn a certain interest on your loan that you made. And then at the end of the 2-year period, when it matures, you get your money back. So in this example, if you bought a 2-year government bond yielding 4% a year, on $100,000, each year you would collect $4,000 in interest. And at the end of the 2-year term, you would receive your $100,000 back for a total $108,000 ending balance on a $100,000 starting balance 2 years later. And so if you hold that bond over that 2-year term, we know that we're going to receive those payments, from that government bond. Now where the math gets interesting is what happens when interest rates increase. So let's say on that same 2-year bond, interest rates go up. So rather than 4%, someone can go buy a new 2-year government bond and make 5% a year rather than 4%. My 4% bond isn't worth as much because I could go buy the new 5% bond and make more interest. And as a result, 1 year into that bond term, if I wanted to sell my initial 2-year bond that earns 4%, I would have to sell it for less than I purchased it for to make up for that lower interest that the buyer is going to receive in turn. And so while all these bonds are liquid, you could purchase, sell them at any point. You don't have to wait till maturity. As interest rates fluctuate, how much someone's willing to buy that bond from you all depends on what else is out there and what the current rates are. And so for this example, illustrative purposes, if you put $100,000 into a 2-year government bond paying 4% a year, interest rates go up after a year to 5%. I may only be able to sell that bond for $99,000 if I wanted to get out of it early, because whoever buys it needs to earn that extra $1,000 between then and the end of the bond to make up for the $1,000 less 1% interest that they're going to receive. And so in this example, even though interest rates went up after a year, so these new bonds are paying 5%, if you were to hold that initial bond for the full 2-year period, you still made the same amount as the initial example. Your $100,000 you get back at the end of 2 years, and you make $4,000 each year, so $8,000 over that 2-year period. And so as long as you hold that bond till term, you do not lose money. The changes in prices are if you wanted to sell it before the term. Because again, in that example, the person 1 year in that decided to buy that bond from you, then by buying it for $99,000 rather than $100,000, they get a $1,000 benefit over the next year from then to when the bond matures. And so that $1,000 plus the $4,000 interest gets them the same as if they're going to buy a new 5% bond at that point, right? So that's the example of the math. While looking at that for 2-year bonds is pretty benign, when you look at it a longer term bond, the math could be very dramatic. So if you buy a 30-year government bond, you loan the money to the government for 30 years at 4% a year. What happens is if after 1 year interest rates go up where someone could make 5% on the new bonds, that 4% difference, that 1% difference earning 4 versus 5 over the next 29 years has a dramatic impact when you look at how long that period is. So for example, if you're earning $1,000 less each year, 1% less each year, over 29 years, that's $30,000, $29,000 less of interest. Therefore, illustrative purposes, if interest rates go up from 4 to 5% 1 year after you buy that 30-year bond, and you want to sell your bond 1 year in, someone that's going to purchase it from you has a big opportunity cost versus getting the new bond that pays 5% a year rather than 4%. And so in this example, you'd have to sell it at a much steeper discount. And you may only be able to get $70,000 to get out of that bond 29 years early. So a $30,000 reduction in price rather than a $1,000 reduction on the 2-year bond. And so this goes to show, again, if you hold a 30-year bond for the entire 30 years, you'll get your money back at the end of 30 years and earn that $4,000 of interest a year. But when interest rates go up on those longer maturity bond holdings, it really swings what the prices are. And this is why literally long-term government bonds in 2022 were down 30%. It's not that they weren't going to make their interest payments. Rather, per the math as demonstrated on the slide, to be able to get even for someone that could otherwise earn a higher yield on the new 30-year bond issuances, that's how much of a discount they'd have to be able to purchase it for. Yep, and so again, you still receive a $4,000 a year. It just having a really longer term, those interest rate swings can be very dramatic on your picture. And so as we think about that, we like to match your bond terms largely to your investment horizon. So, for someone taking retirement income draws, for example, we want to be matching your next 1, 3, 5, 7 years of draws. And so we do not want to be putting too much weight in these 30-year bonds where it's a real mismatch to when you need the cash. Because, for example, if you need to sell that bond in 2 years and interest rates go up, you could be selling at a dramatic discount, right? And this is exactly what happened to Silicon Valley Bank and a lot of these banks where they had a timing mismatch where they had short-term deposits from their depositors and they were investing in very long-term bonds, which could really swing in value as a result of interest rate changes. Now, looking forward, we do feel investors need to continue to be prepared and proceed with caution. And again, no matter what the market does this year, whether it's up, sideways, or down, the one certainty in our view is that we're likely going to have a lot of volatility. And that's something that we need to be prepared for. When we look at the economic outlook out there, it's a bit of a mixed bag. On one hand, regarding concerns, we still have 5% inflation, which is much higher than typically targeted. There's geopolitical uncertainty continues. We're starting to see banking issues in commercial real estate in response to the economy slowing and interest rates going up. And there is still a possibility we may be entering a recession sometime soon. And then on top of it, cherry on top, we have all these debt ceiling concerns out there, as we come across that here in the coming weeks and months. On the positive end, inflation has come down dramatically, going from 9% to 5% as quick as it did, really outpaced what many expected in terms of that retrench. In addition, while we've seen earnings, company profits pull back a bit, they have performed much better than expected. For example, in the first quarter, company profits were anticipated to be down 7 to 8% from the prior year. In reality, they were down a bit, but not much, closer to flat, down 1 to 2%. And so we've seen a very resilient economy. Not to mention that on top of that, we still have very low unemployment rates as well. And so there's been some good resiliency. When it's all told, there's a lot of unknowns out there and different outcomes that can happen. And for that matter, we continue to suggest sticking with the plan. It's important to have a war chest of more income-oriented investments for your near-term, short-term outlays. But for funds that are more longer-term in nature, we do continue to believe that equities, stock market investments, and funds are the best wealth builder over time. And just having the right plan and sticking to it is exactly how you weather through these tough periods. Another note is that there are some positive tailwinds that we're seeing. One of which is investor sentiment continues to be very negative. So much of that mood is priced in. People are not optimistic right now. And as a result, the expectation is that we're going to have some tough sledding. And that is expected and largely priced into the market. In addition to that, in line, cash is at an all-time high. There's over $5 trillion between cash and money market funds out there. And so that's a massive number, well over where it was during COVID period and much, much higher than 2008. The reason this tends to be a bullish indicator is that a lot of his cash will ultimately find its way into the market and the economy and be invested once some more confidence, by different investors and companies out there reaches that point. And so that is a huge number that can be providing a massive, tailwind and momentum as that finds its way back in over the coming months and years. As noted, seasoned investors, we know that long-term growth is not linear. It does not happen in a straight line. I wish it did. And so we're going to have these ups and downs and, valleys and peaks. It's part of the experience. What really matters is when you need those funds, we want to match them to your time horizon. So when you're tapping funds, you are tapping profits and gains and earnings. And so your stock market investments are really not intended to be, something that you're going to need for 7, 10, 15 years down the line in certain cases. And so while it's uncomfortable going through these volatile stretches, remember, this has been a year and a half of a tough period that we've been going through. The last 6 months have actually been decent. And so really, we have a lot of time with your stock market investments, the way that we set it up, to give it time to recover and do what it tends to do over time. So as we look back at a few key takeaways, it is unclear where interest rate hikes will go from here. The expectation is that the Fed may be done or close to done, and we might be seeing cuts towards the end of the year. That is very possible, but there's also a possible outcome where inflation's sticky, especially wage inflation, and we may be having higher interest rates for longer. And so that's something that we need to continue to brace for and be prepared for. Borrowing has become more costly. It's a good time to review your higher interest debt and strategies to pay that down. Likewise, for those of you that have 3% mortgages, in some cases less, that is very cheap debt, right? And so something in a lot of cases we're likely not in a hurry to pay down. So good time to review your debt outstanding. Likewise, income producing investments. On your short-term cash equivalents, we are able to earn approximately 5% right now. That is a very attractive yield on your risk-free investments. And likewise, across bond portfolios, we're earning that north of 4%. And so we continue to be very thoughtful in terms of the term of bonds that we hold and finding that balance in terms of having higher yield and protecting against potential higher interest rates, as well as having a supportive portfolio that will do well and contribute if we do go through an economic slowdown and interest rates do go down. The media loves volatile periods like this. They love to magnify it. They're here to grab eyeballs and advertising dollars. They do not care about our feelings, right? And so, it's really anxiety inducing, watching a lot of these news headlines. And so again, I try to avoid it, especially where it's keeping anyone up at night. And practicing patience and focus on the long term is always the key to investment success. Volatile markets are likely to continue, whether that's up volatile, down volatile, or sideways volatile, something to brace for. That does create fantastic rebalancing opportunities that we are on point on and taking advantage of. And what I mean by that is as we go through periods where the market goes on a nice run, that's a good time to take some gains and refill your more conservative bond investments where your draws are coming from. Likewise, as we go through tough drops like we saw last September, October, those are good times to rebalance and possibly buy more stock low. And so that's something that we always have a keen eye towards. And looking at your budget, reviewing cash flows, mapping out your discretionary versus non-discretionary expenses is a really great exercise just to give you confidence on sustaining your lifestyle. And we are here for you. Again, these are tough stretches, and this is why we're your partner on all this. And so if you ever have questions or concerns or anxiety, please do not hesitate to contact us. Lastly, it's always nice to check in with the Oracle of Omaha for some economic market wisdom. And Warren Buffett recently in a shareholder letter again cited that he has yet to see a time when it makes sense to make a long-term bet against America, and he doubts that any reader of this letter will have a different experience in the future. And so again, it just goes to show patient investors are rewarded. These periods, while uncomfortable, are not uncommon and part of the investment experience. Well, we appreciate you tuning in for our economic market update video. And again, we are here for you. One of our goals this year, similar to last year, is to help more people just like you. Many of our clients were referred to us by existing clients. And so please be a part of our Client Ambassador program, Client Ambassador Club. If you know someone that might be benefited by meeting with us, or we might be able to help, please introduce us and be a Client Ambassador. This is a great way you could bring them to one of our presentations or workshops that we do. Pass on their information. We'd be happy to add them to our contact list and include them in videos that we send out, such as this. And what works really well is an email introduction. Send an email to us, include us on there, and we'd love to connect with them and at a minimum, give your friends, family, colleagues a second opinion, especially during these difficult times. It's so important to have good financial advice. So again, thank you so much for entrusting us as your advisor. We are here for you. Contact us anytime and reach out with any questions. Thank you so much.